Hello and welcome to our Chapter 1 overview for our Introduction to Financial Accounting class. This is Ms. Vanderland. So we're going to try and not make this video too long, but it'll go as long as we need it to. So I'm going to just kind of do an overview of Chapter 1. Just keep in mind when you are watching this video, before you go and watch the whole video, it's important that you have already read the chapter and you've gone through at least those PowerPoint slides. Okay, and that Learn Smart, the Chapter 1 Learn Smart is very important to do as well. You can either do that before or after this video, but it's really going to be helpful if you're always making sure you're keeping up to date with your reading before you get to the lecture video. All right, so let's get started. So what is the primary objective of accounting? Right? Because we're in an introduction to financial accounting class, we really want to know what is that all about. Okay, so what is our primary objective? Okay, the primary objective of accounting is to provide information that is useful in making good decisions. Okay, that's kind of like the umbrella purpose of accounting, is to help decision makers make good decisions, to provide them with that information so that they can make good decisions. Okay, and what is the result of good decisions at the end of the day? At the end of the day, that is going to lead to societal prosperity and welfare is going to be maximized. Okay, we're just looking at the big picture. So there are two types of accounting information. Either it's going to be financial, or it's going to be management-oriented or managerial accounting information. Also, sorry, there's a third, which we won't really touch on too much in this class, is tax. Okay, so financial accounting information, that's what we're going to be focusing on in this class, right? That's what Accounting 2 is focused on. Accounting 4 is what we'll be focusing on with regards to managerial accounting information. And once you end up taking a tax class, that's where that comes in. So financial accounting information describes the financial resources, obligations, and activities of an economic entity. Okay, so financial resources, obligations, and activities of an economic entity. And the main purpose of this financial accounting information is to assist external users. That's going to be a key in this class. It assists these external users of this information, like investors or creditors, and helps them to make what? Good decisions. Okay, it's always going to go back to that. And for this reason, this is all often called general purpose accounting information, because it's not geared towards any one user. It has a general purpose in that many different external parties can use this information for their own purposes, whatever their decision-making purposes are. Okay, so that's the gist of financial accounting information. Managerial accounting information is a little bit different in that it has an internal focus. Okay. The users of managerial accounting information, they are internal users. Okay, you are not going to have external users of managerial accounting information because most of that's going to be proprietary. But this information involves the development and interpretation of accounting information for management at the end of the day. Management is the group that's really going to rely on managerial accounting information or that internal information. And the nice thing about managerial accounting information, it's not general purpose. Okay, this is the kind of information that can be specifically tailored to management's needs so that they can make their own specific decisions. Okay, so that's going to be the big difference between financial and managerial accounting information. And the third type of accounting information is tax. Some of us might be familiar with that area, some of us might not be. But really, this kind of accounting information has to conform as many of us might know, with income tax reporting requirements. Okay. So basically our tax law is really the crux of this type of accounting information. Okay, and the laws and regulations are often different with tax accounting information than would apply to, let's say, financial or managerial accounting information. This is why tax is an entirely separate part of accounting all on its own, because it's so specific. Okay. So I'll be scrolling here with this digital whiteboard as we move along. Okay. So one thing that's important about accounting is it's really an information system. And really, what is an information system? An information system is going to consist of the personnel, procedures, technology, and records used by an organization to develop information and to communicate this information to decision makers. Okay, that's quite a technical definition, but I'll say it again. Okay, an information system consists of the personnel, procedures, technology, and records, okay, used by an organization to develop information, right? The kind of information we just talked about, to develop information, and then to communicate this information to decision makers. Okay. And one thing you'll see me asking you guys a lot about is, with financial accounting, what kind of decision makers are we referring to when we're talking about financial accounting? And the answer would be those external decision makers. Okay. Those outside of the business. Okay. Now, an information system has some basic functions. Okay. And really, again, just so you guys are aware, what we're talking about here is really the bird's eye view of accounting. We're really just looking at an overview of really what is this thing called accounting. As we progress through the chapters, we'll really be getting into the nitty-gritty of it all. So what are some of the basic functions of an information system, an accounting system, in other words? Well, the first one is to interpret, okay, and record the effects of business transactions. Okay. Second is to classify the effects of similar transactions to compute totals to be used in reports. And then lastly, another basic function of an accounting system or information system, they're pretty much synonymous, is to summarize and communicate the information contained within that system to who do you guys think? Right? What's one thing we've talked a lot about, right? And that is to those decision makers, those external decision makers in our case when we're talking about financial accounting. Okay, so when you're looking at accounting, specifically related to, let's say, a specific organization, that organization is going to have an accounting system or an information system, right? And that information or accounting system, what is that made up of? It's made up of the people, the personnel, the procedures that are put in place, right? Rules that need to be followed, technology of computers, software, so on and so forth, and records, right? When you put those four things together, you have a system, right? And the purpose of that system is to create information and then communicate that information to decision makers, right? That's the summarized version of what an accounting system is. And how does it develop information and communicate that, right? Through these three basic functions that we just mentioned, right? The first is to interpret and record the effects of business transactions, okay, which we'll get into with the accounting cycle. 2, classify the effects of similar transactions so we can compute totals to use in reports. And then lastly, summarize all of that information within that system so decision makers can make use of it. Okay? And you don't have to get too bogged down in some of these technical definitions. I just want you guys to really get the gist of it, get the main idea behind really what is an accounting system. Because if we don't really understand that, it's going to be really hard when we actually get into some of those technical items throughout this class to really understand what the heck are we doing, right? So the really purpose of chapter 1 is just to lay a foundation for what really is it that we're going to be doing in this class. So chapter 1's a lot more concepts and vocabulary, where later on as we move through, you'll see there will be a lot more pen to paper. We're learning our debits and credits, learning how to do entries, set up financial statements, and beyond. Okay? So one thing that, especially if you're going to be taking more accounting classes down the line, is one thing that you'll hear a lot about is internal control. This is something that is very important to an organization, specifically from an accounting perspective. So what is internal control? Internal control basically is the rules and procedures. It's going to take me a while to write all this out, but I want you guys to see this. It's the rules and procedures implemented by an organization, okay, to ensure the integrity, that's an important word there, to ensure the integrity, okay, of financial accounting information, okay, and promote accountability and prevent fraud. So that's really what internal control is. It's very important to organizations because, as a lot of us might know, fraud has led to the destruction of many businesses in the past, and which has led to more regulation and legislation, especially within the accounting sector. Okay, so internal control is very important to an organization because it helps to prevent this thing called fraud, right? Prevent corruption, so to speak, within a corporation, and helps to ensure those external decision makers to help them be able to rely on that information that is being produced by that accounting system of the organization. Okay? Because what good is accounting information, right? Let's say I get all this information from this organization, it's great, but what good is that information if I can't rely on it, right? If it lacks integrity, if those within the organization aren't accountable for their actions, right? Then that information becomes less and less reliable, and then we're kind of stuck between a rock and a hard place, right? So internal control is very important. So, well, how would a company go about making sure that its internal control system is where it needs to be? Well, there are different components of internal control. Okay, we'll mention those. I won't go into terrible detail, but I'll at least mention those because I know a lot of you will already have read about all these details. But let's go ahead and look at the components of internal control. And sorry, I'm trying to keep my handwriting as clear as possible, but usually digitally, it's not going to be as good as on an actual whiteboard. So bear with me. I hope you guys can read what I'm writing. So the components of internal control, okay? First is the control environment, okay? So basically, and I'm not going to write all of this down. You guys can take notes as I talk, so I won't write all of it down. But the control environment is basically, it sets the tone for the organization, okay? It's what is this corporation's or organization's commitment to ethical values, right? How important are certain values and morals to this organization, okay? How independent is the board of directors, right? Is their responsibility appropriately assigned to different members of that organization? Are employees being retained, right? Are competent employees being retained, or are we losing a bunch of employees all the time? And it also looks at accountability at all levels, right? That's a big one. Okay, so essentially that is what really consists of your, or what your control environment consists of. Another one is risk assessment. Okay, and this one is basically identifying, analyzing, and managing risks that pose a threat to that organization's goals. Okay, so identifying, analyzing, and managing risks, okay, that pose a threat to a company's goals. Okay, so this involves identifying those risks and then implementing risk mitigation techniques, right? So you can't do anything about risks if you don't identify them, right? So identify risks, analyze them, okay, and then implement mitigation techniques, right? And what the heck is that? That's just basically, what are you going to do about that risk? What are you going to do about that, right? So mitigation techniques is what an organization does with those risks. Now that you've identified and analyzed them, what now? How are you going to mitigate that? Okay. Next component of internal control is actual control activities. Okay. So there's a bunch of different kinds of control activities, right? These are those activities that go on within the organization that help to maintain internal control, right? One of those control activities is basically would be, as a starting point, those policies and procedures that a company has put in place to address risks, right? This risk assessment. And some examples of that would be segregation of duties, safeguarding assets, approvals. Okay, so an example of segregation of duties would be, let's say, for example, the person receiving a check from a customer, right, as payment should not be the same person that takes that check to be cashed in the bank at the end of the day, right? Because that opens up the door for a lot to go wrong and for fraud to take place. So that's just one example, is segregation. That would be a segregation of duties. That would be an example where not one person shouldn't be in charge of a bunch of different overlapping responsibilities. Approvals would be an example of making sure that there's different steps that need to be followed before, let's say, a purchase is approved, right? Because if let's say the secretary at the front desk doesn't have a limit on what she can spend on purchases for the business, and there's no process that she needs to follow, who's to say that there aren't some unnecessary purchases being made, for example? Okay, so just at the basis of control activities, the basic definition of this is basically just the policies and procedures established by management to address risks. Okay, that's basically a main theme here. Okay, and our fourth component of internal control is information and communication. So it's important that information is properly communicated with an organization. Otherwise, what good is that? Okay, so this this component of internal control involves developing information systems to actually capture and communicate information, whether that information is operational, financial, or compliance related. Okay, so what's important for purposes of internal control is for a company to be able to capture both internal and external information, right? But it's one thing to capture that information, and it's another to actually communicate that. Okay, so it's important for the flow of information to be facilitated by an organization. Okay, so this component facilitates the flow of information. Okay, and this flow can be downstream, upstream, and across the organization. Okay, downstream is going to be from management down to employees. Upstream is from employees to management, and across the organization is just across all levels. Okay, because the important point here, and again, it's one thing to have information, but if it's not communicated to the right parties, what good is it? Okay, so part of helping to mitigate risks is making sure that information is properly communicated. And lastly, our final component of internal control is monitoring. Okay, basically, this is the evaluation of your internal controls. How effective are they, right? How effective are our internal controls, are as in the company, okay, or the organization. Okay, okay. This is where we evaluate effectiveness of those internal controls. Okay, and how is this done? This is basically just accomplished through ongoing management activities. Management actually making sure that they're doing their job properly, and supervisors making sure that these controls are being implemented properly. Okay, so that's the overall idea behind internal control and its different components. But at the end of the day, it's really important. All of this is important, but the really important point is just to understand what internal control really is. And again, it's the rules and procedures that a company implements to ensure the integrity of financial accounting information, right? Which helps to promote accountability and prevent fraud. Okay? All right. So remember we talked about those external users of accounting information. Okay? Who are they? Right? So the external users of accounting information is basically anyone outside of an organization, not directly internal to an organization, but outside of an organization. Okay, so examples could be owners or shareholders of a company. Okay, creditors is one we're going to see a lot of, okay, in this class. Possible investors, okay, labor unions, government agencies, okay, like the SEC, for example, which we'll get to. Customers is a big one, right? Customers, even suppliers. And basically, if we want to say just an overall external user, could be just the general public, okay? Because if you think of a public company like Google, anyone can go look up their most recent financial report, right, and see all of that information for the last fiscal year. So external users is just anyone outside of that organization. Now, of course, is there information that can't and won't be shared to external users? Of course, right? That's that management accounting information that we talked about. That stays within the company. Okay? But this one, external users, that's a main focus. And that's a lot of this is just the foundation of what we'll be learning how to do later on in this class. Okay? And I assume a lot of you have never taken accounting before, and that's totally fine because the whole idea behind this class is even if you've never taken an accounting class before, we're starting at the beginning, okay? And then we're going to work our way up. So what we're going to be focusing on in this class, we're spending a lot of our time on, right, are financial statements. Okay, we're going to actually be learning how to set up these financial statements. It's part of our accounting cycle later on that we'll be learning about. But there are three primary financial statements that we're going to be learning about. We're not going to go into depth in this chapter, but we're going to go into depth pretty soon. Okay, one of our primary financial statements is the balance sheet. Okay. Another word or phrase, another name or phrase for the balance sheet is the statement of financial position. Okay. This basically says where a company stands on a specific date. Okay. A moment in time. Okay. This is what I like to call our snapshot statement. Okay. Because it's like taking a picture of a moment in time, right? It's a snapshot, and I won't get into much detail here, but it's a snapshot of a company's assets, liabilities, and owner's equity. Okay. Another main primary financial statement that we'll be looking at is the, see, there we go. We're always going to have a mix up like that, is the income statement. Okay. An alternate name for this and the reason I will always make sure to mention alternate names for these statements is oftentimes if you're going to look at a financial report of a public company, maybe you're working your job one day, they might not call it an income statement. They might call it something else. And that something else that's pretty common is a profit and loss statement. Okay. So instead of this being for a specific date or moment in time like the balance sheet, this is for a period of time. So instead of it being like a snapshot or a picture, this is like a movie, okay, or a film, because it captures a period of time from start to finish. For example, 1 year. Okay, so this is basically a summary of a company's revenues and expenses. And what we'll learn about later on in great detail is that those revenues and expenses help us figure out what our net income / profit is. Okay? And that third primary financial statement that we'll be learning about is the statement of cash flows. Okay? This basically just details a company's activities involving cash. Okay? This doesn't really have a very popular alternate name. That's just statement of cash flows or the cash flow statement. Okay, so this is also for a period of time. Okay, so we can also see this as a film statement, so to speak, right? And this just looks at a company's activities involving cash for a period of time. But the key word here is cash. And those activities, it's broken down to 3 activities: financing, operating, and investing activities, but we won't get into detail beyond that. That is just an overview of those main financial statements that we'll be looking at. Okay, so again, those 3 primary ones is the balance sheet, your income statement, and your statement of cash flows. There are a couple of other ones that we'll be learning about, but we'll defer that to a later chapter. Okay. All right. So with financial accounting, we're working with externally reported information. We're actually gathering and putting together that information to be externally reported. So what are some characteristics of externally reported information? Okay. Well, financial reporting is a means. Okay. It's a means to an end and not an end in and of itself. Okay. That might be a phrase that some of you have heard of before. Okay. So it really has a purpose beyond it just being information, right? It has a purpose. And what is that purpose, right? Well, financial reporting or externally reported information, remember, it helps those outside users to make decisions and overall improve the quality of their decision making. Okay, and it helps to create a prosperous society for that reason. Okay, so basically what we can just point out here is it improves the quality of decision making by those external users. Okay. Now, when we're looking at externally reported information, financial reporting and financial statements, they're part of the same kind of group, but they're not exactly the same thing. Financial statements are just a subset of financial reporting. Okay. So, for example, those three types of financial statements that we mentioned, this is just a subset of financial reporting where financial reporting in and of overall, right, that includes a broader scope of things, right? Financial reporting, okay, doesn't just include those financial statements, but it includes other communication to those external parties, okay? Because keep in mind, income statement, for example, isn't the only way that a company is going to be communicating with those outside users, right? So example of this other communication would be press releases, okay? Disclosures, which we'll learn a little bit about later on, and just other open communications with the public, okay? And another important characteristic of externally reported information is that it is historical in nature. Okay. So financial statements, like those three we looked at, it reports events that have already happened, right? It's not going to occur, it has already happened, right? So financial reporting information focuses more on the past than the future, okay? Just because we're looking at information referring to what has already happened, okay? Another characteristic of externally reported information is that it involves inexact and approximate measures. And I know this will make a lot of you uncomfortable, I'm sure. This is something that I struggled with when I was initially an accounting student, is how, when we're looking at, financial accounting, how in the world or can we be talking about inexact measures and approximations? Okay. Well, in reality, okay, a lot of accounting information has to be based on estimates, people's professional judgment, and assumptions about the past and the future, right? So we're going to have to become comfortable with estimates, right? Or the idea of, just estimating a number, judgments, and assumptions. Okay, because as you'll see, as we get into some chapters, sometimes you don't have a better option other than to estimate or make an assumption. Okay, for an example, I won't go into detail. This is a very chapter much later on, but if you buy a truck that is being depreciated, for example, you can't really know down to the day how long that truck is going to last you, right? But what can we do? We can make a reasonable estimate on how long that truck might be useful and how long that truck might last. Okay, so that's just one example of how accounting might sometimes involve approximations and estimations. Okay, and another characteristic of externally reported information is that it has a general purpose, right? We have this general purpose assumption when it comes to financial accounting information. And we touched on this briefly before, right? This means that financial accounting information, okay, let me clarify there, is not tailored to any one person, okay? We don't say, okay, we're going to tailor us, Google, let's assume we're Google, we're going to tailor we'll make new statements and everything just for Joe over there, right? Or Sally. That is just way too much work, right? Doesn't make sense to do all of that work over and over again for specific people, right? Instead, it makes more sense to create information and package it into these neat packages called financial statements, right? For a bunch of external users, right? For the general public. It has a general purpose so that anyone who might want to use that information can use it for whatever needs they have. Okay, so it serves multiple user groups. Okay, so again, general purpose. Okay, and lastly, our last characteristic of externally reported information is that it is enhanced through explanation. Okay, or its value is enhanced through explanation. Okay, so sometimes qualitative information helps us to interpret financial reports, right? Because if I just throw an income statement at you or a balance sheet at you, if you've taken a couple accounting courses, you might, for the most part, understand what's going on there. But a lot of the times, other bits of information, like what the company might have been through that last year, some significant events that happened that last year, might help us to better understand what's going on in those financial statements. So that's what this characteristic refers to. Okay. So we've talked a lot about these external users, right, which is the focus of financial accounting, the class that we're in. But what about internal users? Who are they, right? What would be an example of an internal user? Well, just think of, okay, who's really internal to an organization, right? Example would be your board of directors, right? What about your CEO, your CFO, maybe the vice president and president of the company, right? You have managers, but you have also specific kinds of managers. You might have a plant manager, a store manager, for example, right? A product manager, product line manager, okay? You have supervisors, okay? Let's say you have a factory and you have someone supervising a specific line, okay? So internal users aren't going to be the ones relying on that externally reported information per se. These individuals are more reliant upon internal accounting information that's a lot more proprietary and held closely to the organization so they can do their job, right? How can a manager improve? Let's say we're looking at a product manager, right? And let's say sales have been down for the last 6 months. Well, a manager, first of all, needs to know that sales have been down for the last 6 months, right? That's information. But there's other information that manager can then use, managerial accounting information, to help solve that problem and to better understand it, most importantly. Okay? And with accounting 4, Introduction to Managerial Accounting, we learn all about that. Okay? So with management accounting information or managerial accounting information, focus of accounting 4, basically the purpose of that, as opposed to financial accounting, this internal accounting information is basically geared towards helping management achieve the organization's mission and goals. Okay? That's really the basis of that, the main idea. Okay? And often with managerial accounting, there's evaluations are made and decision making is rewarded based on performance, right? Comparing one period to a prior period. Okay. But we're not going to be too focused on managerial accounting in this class. We just want to know how it is different from financial accounting. But one way to help us understand how it is different is to compare its characteristics to the characteristics of financial accounting information, which we just looked at, right? So let's just briefly go over the characteristics of managerial accounting information. Okay, the one thing is timeliness. If I can spell that right, timeliness. Okay, it's important that information is received on time in order for managers and those internal to a business to plan and control their activities, right? If a manager finds out, for example, that sales are down, right? Or that a certain product's costs are way too high this last quarter. If they receive that information 6 months too late, what use is that information? Then it's basically useless. They can't do anything about that since it's been received so late. So managerial accounting information has to be timely and received on time. Okay? And a company can really save money by helping their managers make better decisions if they are able to act quickly. If management has information now versus tomorrow, they can make decisions more quickly, and that might help to save money down the line. Another characteristic is it's important to identify a decision maker. Let me actually rewrite that word. Oops. Identify a decision maker. Okay? Where with financial accounting, our users are external to the business, right? It has a general purpose, meaning it doesn't matter who uses that financial report, it's up to them how they use it, right? We don't tailor it to any specific person. But with managerial accounting information, depending on the person, they need specific information so that they can make decisions and fix issues. Okay, so it's important with managerial accounting information, you identify who's the decision maker. Who is it? Okay, well, it's this manager over in this department. Okay, now let's get the right information to them. Managerial accounting information is also future oriented. Okay, the whole purpose of management information is to affect the future, right? So that we can make improvements and do better down the line, right? And it's also important to motivate management to make decisions that's going to help achieve the organization's goals down the line. Okay, so as opposed to being more focused on the past, like financial accounting information, managerial accounting information is more future oriented, right? Less focused on the past and more focused on looking ahead. Okay. It's also another characteristic of managerial accounting information is efficiency and effectiveness. Okay. A lot of managerial accounting information helps to measure how effectively and efficiently resources are being used. So with managerial accounting, which focuses really a lot with cost accounting, that's a lot of what we're focusing on with managerial accounting is really how effectively are we using these resources and how is that affecting our bottom line. Okay. And lastly, it is a means to an end, just like financial accounting information as well. It's not an end in of itself. Okay. Ultimately, the objective is to design and use an accounting system that's going to help management do what? It's going to help management to achieve the goals and the mission of the company, the organization, enterprise, whatever you want to call it. Okay? So that's basically an overview of financial and managerial accounting information and how they overlap and how they are different. Okay? Now, when we look at accounting information, in general, one very important thing is that it requires integrity. Okay? And what does integrity really refer to? Well, our text has actually given us a nice breakdown of really what that comes down to. And they refer to it as complete, unbroken, unimpaired, sound, honest, and sincere. Okay? So those are just some words to help us kind of jog our memory of what integrity really refers to. And most of us probably know what integrity means, right? But when it comes to accounting information, how can accounting information have integrity? That just means that that information is whole. It's complete, right? And it's honest in the fact that there is nothing being withheld that shouldn't be, right? Things are as accurate as they possibly can be, so that what? Why does accounting information need to be complete, unbroken, unimpaired, honest, so on and so forth? So that those external users of the accounting information can rely on that information to do what? To make decisions. So if integrity is important, I'm sure we can all agree on that, right? How might we enhance integrity? Seems like a pretty important thing to focus on, right? Enhancing integrity of accounting information. So there are three primary ways that integrity can be enhanced: through institutional features, which we'll just briefly touch on, professional accounting organizations, and then lastly, basically just the personal competence, judgment, and ethical behavior of those involved with and those involved with compiling that information. Okay, personal competence, judgment, and ethical behavior. Because as you will see, there are some very specific rules that we need to follow when we record accounting information and gather it. So if someone doesn't really know how to do that, right, they lack competence, right, or they lack the ethical backbone to do things correctly, right, or they want to withhold information, that really strips accounting information of its integrity and its ability to be relied upon. Okay, so the first one we said one of the first ways to enhance integrity is through institutional features. So one of the main ones that you'll hear me talk about all the time, and that is really going to form the foundation of a lot of those rules that we're going to be learning about, is GAAP. Okay, GAAP stands for, and I'm actually going to write this one out just so once we've written it down once, we can really get it down. GAAP stands for Generally Accepted Accounting Principles. Okay, so this is basically the general framework, okay, for determining what information needs to actually be included in those financial statements that we talked about, and how that information needs to be put together, how that's going to show up to those external users. Really, GAAP, because we have all this information, right? If we're looking at an organization might have a bunch of information, a bunch of these transactions. But what GAAP helps us do is figure out how we need to bundle that information into these neat little packages, right? Which can be those financial statements, or essentially the financial report, so that those little packages can be delivered to those external users so that they can actually make use of it. Okay? GAAP can change at any time. It changes over time. It's dynamic. Okay? And it really comes from a mixture of tradition, meaning just this is how accountants have done it all these years. But it's a mixture of that, mixture of experience, and then official decree, meaning there are standards put in place, laws that need to be followed. Okay, so GAAP, that's basically the main idea behind GAAP. So since GAAP has this framework in place that accountants need to follow when compiling and organizing this information and presenting it, that helps to enhance integrity information since there is this framework that needs to be followed. Okay. Another one is the Securities and Exchange Commission, which some of you might have heard about. For short, we can refer to that as the SEC. Okay. So basically, this is a government agency that has the legal power. Okay, we'll say legal authority or legal power to establish accounting principles and financial reporting requirements. Okay, the key here is for publicly owned corporations. Okay, so they basically have the power to establish all of these accounting principles, but they have delegated that responsibility. Okay, so it delegates standard setting to another group referred to as FASB. It's a private group, which we'll talk about in a second. And the SEC, they review the financial statements of these public companies. Okay, and if they find anything that is not in compliance, or there's an issue that they find, or they maybe discover fraud, they can initiate legal action, meaning companies can be dragged to court. Okay, and so the FASB, or FASB, but everyone just refers to it as FASB, is the Financial Accounting Standards Board. Okay, so this is a private group. Okay, it's not a government agency. They are independent, but they are an independent rule-making body. So remember, these public companies have to follow all these financial reporting standards, right? Those reporting standards really come from the SEC, but the SEC basically said instead of us having to do it, we enforce it, right? We enforce those standards. So the SEC has deferred that responsibility of making those standards to the FASB. Okay, so the SEC basically enforces those accounting principles and financial reporting requirements, but the FASB helps to set those standards and those rules. Okay, and the FASB is recognized as the most authoritative source of GAAP. Okay, and lastly is the IASB, which some of you might have guessed it, is the International Accounting Standards Board. Okay, so basically, FASB is specific to the United States. IASB, this is a London-based group. Okay, they issue international reporting standards. Okay, financial reporting standards, which refers to IFRS. Okay, so where FASB is focused on GAAP, right, or US GAAP, so to speak, because GAAP really has a general connotation, US GAAP. IASB is going to focus on those international financial reporting standards. Okay, so there's a lot of talk about, okay, well, at what point is FASB and IASB going to converge completely so that it just makes companies' lives easier, right? Well, the likelihood of these two groups really converging their standards anytime soon is pretty slim, just because there's so many complexities involved with both. There's a lot that's the same with the rules for both FASB and IASB, but there's also a lot that is different. There's over 100 countries, including the European Union, that require companies to use IASB, right? But if you're in the US, you have to follow what FASB puts forth, right? So that kind of makes it a little bit difficult. Let's say you're an investor, for example, and you're wanting to compare Google, right? You're trying to figure out what to invest in. You want to compare Google to a foreign competitor of Google. Okay. Well, I can look at both companies' financial statements, right, to help make a decision on which one do I maybe want to invest my money in, right? But if I know that Google's financial statements are put together in accordance with FASB's rules, but the foreign competitors' financial statements are put together under IASB's rules, I probably should recognize that maybe it's not like comparing apples to apples. It's more like comparing apples to oranges, right? So that is one of the things that, one of the issues that arises when it comes to the existence of these two separate rulemaking bodies. Okay, but I'm going to defer that to a more complicated accounting class down the line for those of you that will be taking that down the line. We won't be diving that deep, but just know that that is one of the big topics in accounting involving convergence of accounting standards globally. Okay. And we're still on institutional features that enhance integrity. And then the other one is the PCAOB. It's a long one. It's always a mouthful. This refers to the Public Company Accounting Oversight Board. And basically, this group, it was created by the Sarbanes-Oxley Act of 2002. And this basically changed a lot with regards to regulation in the accounting profession. So basically, we are not going to go into incredible detail, but this group is basically charged with oversight of the public accounting profession. Okay, it is the group that sets auditing standards for when those public companies are audited by CPA firms. This group is the one that actually sets those auditing standards, and they also inspect the quality of audits and see whether or not these companies are in compliance. And they also conduct investigations if they suspect that there is lack of compliance with these audits, and they will also administer penalties as well. Okay. And lastly, financial statement audits. Okay. So basically, an audit is just an examination of a company's financial statements. Okay. And the audit looks at how fair these statements are. Are they a fair representation of the company's financial position and how the company is doing? Every public company needs to be audited at least once a year by law. And this has to be done by an independent CPA firm. No one can just come in and do the audit. It has to be done by an outside CPA firm. Okay. And how do they judge the fairness of these financial statements? They are based on the standards of What did we talk about before? GAAP, right? So that's what it's based off of. Are these financial statements in accordance with GAAP? And are they a fair representation of the company's position? Okay. And we also have legislation that helps to enhance the integrity of financial accounting information. So Congress passed the Sarbanes-Oxley Act in 2002. I'll actually write out the full name here, Sarbanes-Oxley, SOX for short, of 2002. Okay. Basically, this came about with all of those scandals involving WorldCom, Enron, Arthur Andersen, so on and so forth. With all that fraud that was going on, it forced the government to put forth legislation to prevent that kind of catastrophe from happening again, if at all possible. So basically, what came out of this legislation is that auditors are prohibited from also providing non-audit services to their audit clients. So if a CPA firm, for example, is the auditor of a company, they also cannot provide consulting services to that company at the same time, because that would represent a conflict of interest. This legislation also put additional responsibilities on the backs of the board of directors and audit committees. And another thing is the CEO and the CFO must certify or basically sign off on the company's financial statements. So what's the implication of that? Well, if a CEO, okay, let's say you're a CEO of a company and you're looking at, here's the financial statements of the company. You know, there's some fraud been going on within the company, but you know what, you're not really been too bothered by it. They put these financial statements on your desk and you go ahead and sign them. You're just like, yeah, they're good to go, right? Well, after the passage of SOX, a CFO and a CEO, after signing off on these financial statements, if something goes wrong, right, and a company is found to not have a fair representation, or for these financial statements not to be a fair representation of the company, the CEO and the CFO might face jail time or just any kind of legal ramifications. Okay? It's not unheard of for a CEO to be thrown in jail for 50 plus years for these kinds of issues related to fraud and corruption, and so on and so forth. So this has some big implications. So if you're a CEO, you have a lot of responsibilities from the get-go, but now with the passage of this legislation, you are now when you sign off on these financial statements, you are certifying them as being a fair representation of the company. So if it comes out down the line that actually it is not, and there's a lot that has gone wrong, then you will likely be in trouble for that. Okay. We also mentioned that professional organizations also help to enhance the integrity of financial accounting information. I'm not going to go into incredible detail, but I'll just mention them to you. Okay, so we have a professional organization referred to as the AICPA, which is the American Institute of CPAs. So basically, they are tasked with just providing members with relevant industry knowledge and keeping those CPAs up to date with all the information that they might possibly need within the profession. And they also conduct research, and they work really closely with FASB with establishing GAAP and interpreting it as well. Another organization is the IMA, which is the Institute of Management Accountants. So similar to the AICPA, but based on management accounting. So they basically do research They practice development, education, and they share knowledge amongst themselves and those within that profession. And they also advocate for the highest legal practices within the profession of accounting and finance. And it also influences the concepts and practices for those working with management accounting and also financial management as well within that sector. And they also offer the CMA designation. And there is also the IIA, which is the, let me just write that, Institute of Management Accountants. So the IIA is the Institute of Internal Auditors. Okay, so they are basically dedicated to the practice of internal auditing. So it's just a professional association dedicated to that, and they offer professional development through to all of their members. You can go to conferences, seminars, so on and so forth. So this is the Institute of Internal Auditors. And I'm just mentioning, we're not going to go into much detail with this. We just wanted to know about their existence. There's also the American Accounting Association. Their focus is more on furthering the discipline and professional accounting through education, research, and service. So they're more focused on the education side of things. And you'll see more accounting teachers and educators involved with the AAA as opposed to those other organizations. And there's also COSO, or the Committee of Sponsoring Organizations of the Treadway Commission. It's a very long name, so we'll go with COSO. It's just a private sector organization, and basically they are dedicated to developing standards of internal control. That's basically its main dedication. All right. And we are almost done with our overview of Chapter 1. All right, so there are some certifications that accountants can get to enhance their competence and enhance basically their resumes and their reliability based on whatever job it is they'll be doing. A lot of you might have heard of CPAs before, right? It's a certified public accountant. This kind of license is done through the state that you live in or work in. You have to have at least 150 hours of college semester hours, mostly within the discipline of accounting and also business. You have to pass the CPA exam, which is actually 4 separate exams. And you have to actually have professional experience as well to get that license. And once you have that license, you have to spend at least 40 hours doing continuing education every year. But, it pays off, because if you have the license, you will end up being able to earn more money as opposed to someone who is just an accountant but doesn't have the license. But some people decide also to become CMAs in addition to CPAs, or instead of becoming a CPA. And this is a certified management accountant. This is very similar to the CPA certification in terms of what needs to be done, in terms of the requirements. You also have to pass an exam as well. But this obviously is going to be focused on the managerial accounting side of things. Okay. You can also become a certified internal auditor, right, or a CIA. And basically, this is the focus of this is just on internal auditing. You're becoming an expert in that field. This also has similar requirements to the CPA license to become a CIA. So basically, all 3 of these have similar educational requirements, experience requirements, and so on and so forth. So accountants, someone becomes an accountant, or they study accounting in college and they get a bachelor's degree in the subject. They usually have a lot of options in what direction they can go. Accountants can specialize in a bunch of different fields, but generally is broken down into 4 main categories. You can decide to go into public accounting, which is basically the focus of our class this semester. You can decide to go into management accounting, which you'll learn more about in Accounting 4, government accounting, and then accounting education, which I actually decided to go into, okay? Seeing as I'm your instructor for this course, okay? So CPAs, okay, this is not the only thing involved with public accounting, but for example, a CPA would be considered part of the public accounting profession. A CMA would be considered to be part of the management accounting profession. Government accounting would prefer to, let's say those accountants that go in and actually do the accounting for certain governmental agencies, even if you decide to work for the IRS, for example, right? That would include or be part of that category. Accounting and education, if you decide to teach, right? Like I decided to do, or even if you're involved with some of those professional organizations as well. So, but at the same time, you don't have to become a CPA, a CMA, or internal auditor, or any of those things to be involved with accounting. You don't need necessarily a license to work in the accounting field. But what about bookkeeping, right? Because that's usually what a lot of people think of when they think accounting, right? This is just the clerical side of accounting. Are we going to be learning about this? Yes. Okay. Basically, a lot of what we're going to do in this class is learning about the clerical side, how to record routine transactions that happen every day. We're going to be focusing a lot on that, right? We're going to be learning about the ins and outs of the accounting cycle, right? Debits and credits, so on and so forth, right? We're going to be learning all of that. Do accountants need to understand bookkeeping? Of course. But when it comes to professional accountants, they're not the ones really doing the bookkeeping, right? That's usually the bookkeeper's job or the other accountants' jobs, where professional accountants, they're more focused on interpreting and using accounting information. So with bookkeeping, that's putting the information together. And with professional accountants, they're more focused on now taking that information, interpreting it, analyzing it, and actually using it. Okay? So an accounting background is going to be valuable for anyone that's going to be going into any kind of business, any kind of management, any kind of administration, anything related to the topic of business or accounting. Now you might think, I'm sure a lot of you in this class aren't accounting majors. That's usually usually how it is. Most of my students aren't accounting majors. But it's important to notice that even though you're not accounting major, you might be a business major or you have a completely different major aside from business, is that accounting is, and regardless, it's going to be very valuable, a very valuable tool for you, because accounting at the end of the day, as cliche as it might sound, is really the language of business, right? It helps us to understand really the background or the ins and outs of what's really going on when it comes to looking within a business or trying to understand things that happen in our world. Even if you have better understanding of accounting and even finance, really as we go out into the world and we start our careers, we have a better foundation to understand some of those things that are happening. So it's not just for our professional lives, it's our personal lives as well. If you have even some background of accounting, it's going to help you with personal budgeting, planning for your future, for retirement, or planning for college. When it comes to buying a new house, right? Am I going to buy the house or should I really instead focus on renting? Evaluating whether a loan actually has good elements to it, right? Is the interest rate too high? What does the amortization of that loan look like? That might sound like a scary word now, but don't worry about that. But just know that whether you're an accounting major or not, knowledge of accounting is going to be invaluable, whether it's for your personal life or it's for your professional life. Okay, so I want everyone to really dive into this class with an open mind, because I'm sure that you'll find some practical applications to this in some way, shape, or form, regardless of what your major might be. So I know this has been a long talk about chapter 1, but don't fear, not all of our chapters are going to be this vocab heavy. I know this probably wasn't the most exciting or riveting video that you've ever seen, so I know that. But unfortunately, we have to get through these little, more boring vocab focused things, so at least we can lay the foundation for what we'll be talking about later on. There's going to be a lot of pen to paper kind of working things out and figuring things out as we get into later chapters. So we'll get to do that and get to work problems out. But as we get started in this class, we have to get through some of these more conceptual items. So after this video, make sure that you go back to that to-do list and you make sure that you're completing each items in that to-do list for chapter 1, and make sure that you're completing all of your assignments on time and by the due date. Okay, so I'll see all of you guys on our first Zoom meeting very soon. Make sure that you go to at least one of the sessions, as it is mandatory. But we'll talk soon, and good luck with chapter 1.